Welcome to this week's Q&A. I'm Andrew Unterweger and wish well to all of our Aussie expat clients around the world and our Aussie clients back home in Oz. This question was asked of me just the other day by one of our clients, and he said, look, I don't really understand how some of these tax deductions work around my investment properties. And I said, well, what don't you understand? And he said, well, this non-cash, this depreciation, how does that work? And it's a very interesting question because, as I pointed out, there are two ways of looking at this. Because what happens if you buy a new property, for example, if we just look at the construction costs, so the actual depreciation on that, and I've got behind me just an example there. Say you buy a property for 1.6 million and the construction cost of that property was $1 million. So you get to utilise a 2.5% non-cash tax deduction each and every year for 40 years. So you eventually can write off the whole cost of that construction. Now let's look at that and say, well, you know, if I've kept this property for 10 years, I've been able to deduct $25,000 a year against my income each and every year, and I haven't spent that money. So that's a pretty powerful savings mechanism, because that means after 10 years, you've written off $250,000 against your assessable income. And this person said, well, look, I'm an expat, I don't live in Australia, so how does that work for me? Well, it's exactly the same in many ways, because as an expat, rental income becomes Australian taxable income, and we're paying as non-residents 32.5% tax from $1. So you actually get a tax saving right from day one and $1, as it were, of these write-offs that you can offset against the rental income from the property. And let's say it's a $1.6 million property. Let's say the rental income is $60,000 per year. Well, you're going to be able to deduct $25,000 there, and then we look at fixtures and fittings. So we always tell our clients to get a quantity surveyor's report done when they purchase a new property, and in this instance, there's probably going to be another, say, $35,000 worth of non-cash write-offs that we could utilise against that income. So $25,000, $35,000, $60,000. You're virtually going to be paying no tax on that property, and that's even if you've purchased it with no loan attached. So if you've paid cash for that property, that's what this example is looking at, to make the numbers easier to understand. In reality, of course, most people utilise leverage when they buy property, especially investment property, and we can run through all of those scenarios for people on an individual basis. So please reach out and let us know if you have a query around that. But it is actually a really powerful mechanism for saving money, and at the end of the day, you can sort of convert that into saying, well, look, I may have paid 1.6 million for this property, but in reality, the cost of that property can be coming down over time, if that's how you want to view that, that in terms of your overall portfolio. So I know it's an interesting situation. I know many people would like to ask more about that. Let us know, and we can perhaps dedicate a more in-depth session to help people understand that. I'm Andrew Unterweger from Wise Guru. I hope you have a great time, and I'll see you next week.